Welcome to the lecture on the conceptual framework for financial reporting. This lecture is purely going to be a summary of the most important aspects of the conceptual framework. Now, before we get going, remember that the framework is a theoretical base, a general reference or framework for standard setters, for preparers, for users, for auditors, for other government regulators, etc., to understand general purpose financial reporting and to assist standard setters in their setting of new standards. Now, what are the most important aspects within the framework? Obviously, the objective of general purpose financial reporting is the foundation. The building blocks all build on top of the foundation being the objective. From there flows the qualitative characteristics of useful financial information, i.e. what makes financial information useful to the users. Next up, the accrual basis and the going concern assumption are very important and key aspects of all general purpose financial reports. The framework then goes on to define the elements of the statement of financial position and financial performance, namely assets, liabilities, and equity, as well as income and expenses. And the last important thing I'm going to focus on in this lecture is the recognition criteria. When are you allowed to recognize the elements that we have just looked at defining? So the objective in terms of the 2010 conceptual framework, please, we're not looking at the 1989, the outdated objective. The objective of general purpose financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. So please, the old 1989 framework looked at users being a wide range of users. Here, the 2010 objective looks at a more focused group of users and gives primacy to existing and potential investors, lenders, and other creditors. Now, from there, we look at the qualitative characteristics. Once again, the 1989 characteristics have been partially replaced, and now we have a new structure to how the qualitative characteristics are looked at. So first of all, we'll have fundamental qualitative characteristics that are key and vital to making financial information useful, and then enhancing characteristics that will improve the usefulness of financial information but are not fundamental. So under fundamental, there's relevance and faithful representation. As part of relevance, there's also discussion on materiality. Enhancing characteristics are comparability, verifiability, timeliness, and understandability. Moving on to definition of elements. The definition of elements are going to be discussed under financial position elements and then financial performance elements. Under financial position, we are going to have assets, liabilities, and equity. Financial performance is made up of income and expenses. Under financial position, the asset definition is as follows. First of all, you must have a resource that is controlled by the entity, resulting from a past event, and from which there is an expectation of an inflow of future economic benefits. Here, please understand, resource is some type of potential access to future benefits. Control over those resources is the ability to restrict others from accessing the future benefits. Liabilities are going to be built around the concept of a present obligation. That present obligation must result from a past event, and there must be some outflow of future economic resources in order to settle that liability. Equity is a residual interest concept, and residual interest means assets minus liabilities. Financial performance, income and expenses are in essence defined in terms of assets and liabilities. So income is defined as basically an increase in assets or a decrease in liabilities that would result in an increase in equity other than contributions from equity participants. Expenses are just the opposite. Expenses are increases in liabilities or decreases in assets, and that would result in a decrease in equity other than distributions to equity participants. Once you have discussed or have a transaction, event, or circumstance that meets the definition of one of the elements, then you apply the two recognition criteria. Remember, these two recognition criteria are applicable to all assets, liabilities, equity, income, and expenses. Some assets, liabilities, income, and expenses will have additional recognition criteria as per their own accounting standards. The most common one that pops into my mind is revenue. Revenue has additional criteria, more strenuous criteria for recognition. So the two recognition criteria are: it must first of all be probable that future economic benefits will either flow to or from the entity. Flowing to the entity for assets, flowing from the entity for liabilities. The second is that there must be a cost or value that can be measured with reliability. So that is now the discussion in terms of the conceptual framework for financial reporting, and the summary is only a starting point. Please, you need to go and read the framework, watch some of the other more detailed videos, and then start your studies of the accounting standards. Thank you.